we're going to keep going on it today. We're going to get into variable costs. This template will be included in the SmartHelping.com categories of SaaS, real estate, and startups. It fits a lot of the categories. And remember, you can get all financial models that I've ever built for $9.99 on the site, and that includes any future work that I do. All right, sound check real quick. Make sure this is working. Check real quick. Make sure this is working. Sounds great. Uh, Live financial modeling, property management, biz, variable costs, and fixed costs. So today we're doing variable fixed. Um, we'll see where else we get today. Let me pull this up. So our variable costs right now we're gonna have to do it for two different customer types. So we have, property management companies are going to be signing up customers, which are landlords, and we're allowing for two different configurations of customer channels. So we're going to have, so these costs, average monthly cost per unit managed. This would be, cost of software, all the implementations of that. Now this is not if you are you might have software engineers and staff. This is not that. This is just any variable cost directly related to the count of units being managed. Then we have one-time cost for a new client onboard, monthly maintenance cost per unit under management, and application cost to run background checks and all of that. So they might not all be applicable, but they might be, and we need to tie them to all the different revenue options that there are. So this is variable costs type 1 customers, and they might be the same for both, but they might not be. So we need to account for both types. And we'll put this here. So we did all the revenue options work great. It's really cool. We got this, like we can do percentage of rents. We could charge based on a flat monthly fee or per unit fee, and that will all adjust this here. You see right now at a per unit fee of $5 per unit, we're getting $16,000 a month, 18, 21. If we did a percentage of rent, a little bit more. And remember, this is a good way to also isolate variables and compare, well, what if you were to charge customers based on percentage of rents in some different configurations versus the same customers but charging them a different amount and forecasting that over 5 years. So this is also a really good just comparison tool, pricing tool, and it will get even better when I add these variable cost functions in. So let's do that. Let me just check my text here, make sure I don't have any text errors. Consolidated ending unit count. Okay, here's a text error. This needs to be type 2. Total other revenues. Okay, good. And this is all type 1. Okay, perfect. All right, so we have total revenues consolidated. Now let's get into variable costs. Type 1 customer variable costs. And we have 4. Now we can also do, so let's see, this is per unit. This is onboarding. We can also just apply a general cost, which is just going to be a fixed monthly cost. Well, you know what? No. That's just, we'll save that for the the fixed cost schedule because there's no reason to try to mix these in. So these are just all going to be dependent on the growth of the business. So we have these two. Then we'll do type 2 customer variable costs, and same as these. Whoop, wrong way. All right. Oh, nice. The underlining's working today. Yesterday, Excel was being really annoying with that. Let's see if these. Nope. For some reason, this one is underlined the entire row still, and I don't know why. Maybe, wait, let me put this as general. Ah, there we go. So if you do accounting and try to underline, it does the whole thing. So let's do that. Perfect. Messing around with that yesterday. Other revenue. Perfect. All right. So we have variable costs. Let's do the first one. So average monthly cost per unit managed. This is pretty easy. We'll just go variable cost here. This times units under management for type 1 customers. And that's right here. So very easy calculation. Let's format these. These are all going to be custom with the little dash if it's a 0, no commas, or no decimals. One-time cost per new client onboard. This is again easy, so we have our new customers added here based on our assumptions, and then we just do one-time cost on that. Monthly maintenance cost per unit under management. So this is if you're providing maintenance, repairs and maintenance, you can break it down into a per unit cost per month. And we have ending unit count type 1 here. Whoops, that unit count times the variable cost per month per unit. And now this is actually a little, oh, we got lock D7 on that. This is a little tricky, I believe, to do the application fees. So application fees, we have some logic here. It's fairly complex and we never broke it down. Let's see. Can we figure out the count of applications? I believe yes, because we have one application fee amount for an input, which is shoot. We actually have well, potentially it might be different for initial versus ongoing, but it's very likely not going to be. So I'm going to have to copy this matrix thing down, and we're going to have to but we'll leave out the value so that we can get just a count of application fees that are happening. So revenue, we basically want to leave out 34 and 38, and I believe that gets us the number we want. So let's take out 34 and 38. And now we should be getting a count. Oh, what happened? Oh wait, we need these in the same position, so just copy this, paste here, and then what did I say? 34, 38 we don't need. So let's take those out. Okay, so 188 and then 222. So that's the cohort of that customer that was added. Now the thing is, we actually don't know on a given month Do we know if it's, I mean, the initial one's always more based on our current assumptions, meaning the first initial is like 100%, and then after that it's 1%. Trying to think if how we do this best. So I think the best way is we do a second. So we have application counts, and then we're going to have to do, well, trying to think here. Um, so actually, if we do this logic, however, let's make this the exact same as this, except I got it. Okay, this will work. We don't care about application counts. We just replace, so 34 was the amount of revenue per application. We just replace that with the cost, which is here. And that's not changing on this end. The only thing that's changing is the count that are new versus ongoing, but that's already in the formula, so that's fine. We just have the total application count, and then we're multiplying that by variable cost D8. So that's the actual cost there. Did I lock it? Yeah, D8. Okay, good. And if you wanted to back into the actual applications being processed, you could just divide that by the application cost. Okay, looking good. And that should be going down over time based on the retention rates on customers. Remember, your property management customers, it's not guaranteed they're going to be your customer forever, so we do account for attrition over time based on each cohort that joined. So this is application costs. And for that one, we just reference it directly here. Now, if we put this cost at 50, it should be the same. This is a good check. So 9375 should be the same as the application fees for revenue, which is 9469, 9469, 9563. Okay, so that looks like it's all working perfectly. Okay, so we got total variable costs, type 1 customers. This will be type 2. And we just sum up that. It's going to be top and bottom border, format, light gray. No need to bold this, but I will bold the grand totals. Okay, now for type 2, same idea, but we go now to, so average monthly cost per unit managed, we go to units under management for type 2, which we have broken down right here. And let's make sure we didn't reference that up here. So 30, that's 32. We did 12, 8, 12. Okay, good. So units under management times monthly cost here for type 2. And then one-time cost per new onboarded client. Okay, we do new customers added per type 2 times one-time onboarding costs, monthly maintenance. Let's make sure we did this right. So this was 32.28, and this will be 32 again. Ending unit count under management times monthly maintenance. And then for applications, we just take our, go to matrix 2, take this, this is application costs, and we just replace out the revenue per application with the cost per application. And in this case, that would be D14. And I believe 76 is the right one to replace. Let's make sure. Let me look at the, so 72 and 70. Oh, wait. No. To try to do that too fast. Let's redo that. So D72, I believe, is definitely the first one, right? Yeah, application fee. So that's going to be application costs D14. Okay. And then our second one is 77. And let's double check that. Oh no, it should be 76. Oh wait, that was right. 76, that's the one we had. Okay, so that was fine. All right, so there's the cost there. And that needs locked going up and down. All right, guys, we are moving and grooving here. And there's that cost. So now all the hard stuff's pretty much done with the model. We just have to tie everything together. There's our total variable costs. We'll put it here. Consolidated variable costs, and then here we can put gross profit. Now this will be bold, and it's these two. And then gross profit will actually do a top and double bottom, bolded. A little bit darker, it's our first subtotal that's important. So we do revenue minus this. And then your profit margin is that gross profit amount divided by total revenue. And that will change as all the assumptions change. All right. Now, if we wanted to consolidate this so you can just see high-level revenues, we'll group these columns so we can group that, consolidated. You could always change these if you wanted to group different sections. And then here we can just do all of these. So technically you could just show, okay, here's my total revenues for this customer channel. Here's my total revenues for this customer channel. Here's the total of both of them together. Here's your variable costs, and here's your gross profit. Now, we have a good, this is good for obviously margins and operating margins or gross profit margins, but we do need to know, well, what's it going to cost to keep, we have overheads, other overheads, managers, staff for maybe building software. So we got to account for all of that. So let's get into it. Now, so the variable cost is pretty simple. Let's do a fixed cost, and we'll simply pull that from another template because it's pretty generic. We'll just pull it from, let's see, take it from a SaaS one. The enterprise SaaS one's pretty good to use. And where's my other costs? Here's that. And we're just doing a 5 year, so this is fine. And we'll have some other catch-all costs that run out like as a percentage of total revenues or other just fixed monthly costs. Now on these, you'll be able to determine the start month and the monthly cost in each year. And there should be plenty of slots to handle most operations here. And honestly, I think what I do 30 for each of these 32 slots. If you needed to, usually you might not have much research and development costs, so you could use these as G&A as well, or sales and marketing or whatever. Well, no, you might have some developers building custom software, so there's a lot of slots here for most sized operations. Let's give these a dynamic drop down. Data validation, just so they have the right dates. We have our dynamic list here. Okay. Perfect. And then these should all be staggered so I can double check they're working once I do the final formulas. Oh, perfect. Oh, this needs updated too. Okay. I like in the model, it's pretty useful that the launch year defined here will adjust the drop-down start dates automatically. So if you change this, then your selections for possible start months will then change. All right, let's put this in. So fixed costs, pretty straightforward. We'll take here, give a couple spaces, and fixed costs. Now for this, I like to just drag it all the way down and then do an index formula that references the right position. Then I don't have to do any extra work. We don't need the in-between. That's fine. And then I'll just simply say, well, yeah, let's do this formula first. So I'll say if this state is greater than the end month defined, then the model needs to stop, so 0 out. Otherwise, if E4 is less than the start month here, then 0. Otherwise, index the whole row, or yeah, whole row. Match, I think E3, I'll have to check that, is the year. This, 0. Let me see what was our year was E2 actually. And that locks. That can flow. That lock's going over. This lock's going down. This lock's going over and down. And this lock's down. Now, let's see. Does this make sense? Well, we're about to find out. Yep, looks good. So if our date is greater than the end month, zero it out. If our date is less than the start month of the cost, zero it out. That allows you to have dynamic start months within each year with this column. And I can drag this all the way down. And I'll relabel this. These are just function total monthly revenue, and this is other fixed costs. Give these an indent. Looking good. Looking good. Looking good. All right. G&A and sales and marketing. You'll notice I want to get all these formulas in position before I start changing anything. And let's give these a format. There we go. Perfect. We can clear out this, these two. These are percentages right now. We'll have to multiply. So this is going to be multiplied by total revenue is here. So that's a catch-all. These are fixed. Let me make sure these are working. Jan, Feb, March, C107. It looks like. Why is this? 15, 16, 17. Ah, no. Okay. We need to add these three in here. Okay. Now, there we got the stagger. Perfect. Now we don't need that reference. Let's check real quick if we have any references to on the workbook to any other worksheets. No, good. You always got to watch that when you're copy and pasting from other workbooks. I see that a lot actually. When I'll work on client sheets, they'll send it over and they'll have references to all kinds of other workbooks, and that is not helpful or good for errors. And I mean, it's going to cause problems. All right, so now we can label. So these are sales and marketing. General and administrative. And research. Whoop. We'll also need to put a space under so we can get the total of each. So here I want to say total sales and marketing costs. Now what this would be is like, and this would be like spending on ads, uh, advertising, whatever, marketing, uh, sales managers, marketing directors, all that kind of thing. And this will be used as a way to calculate, like an enterprise SaaS. You want to figure out what's your cost per acquisition, which is really important for any business that has recurring revenues based on contracts. So we're going to figure out that based on the number of new acquisitions, what it costs in sales and marketing, and we'll have lifetime value to CAC ratio, all that stuff. All right, so G&A, oh, we can clear this out. So that's good. Let's give this a total. Total. Also give this a little space up above. All right, and lastly, total research and development. Perfect. Now we can group these as well if we want to condense down the sheet. This is basically just a pro forma summary. We're going to get down to cash flow. We will end up having taxes, depreciation, options, exit value, all that stuff's going to flow into here once we get the other financial statements done. Gotta put this in as well for these two. All right. We are cooking here. Good progress today on this. And then we do total operating expenses. That's going to be all this. So this plus this plus this plus this plus that. Okay, and then we have net or EBITDA, or essentially net operating income. Go top, double, bottom on this, and actually a bit darker. This is another important row. This could just be top and bottom. Yeah, so gross profit's darker, and then total opex in that. Okay, and then profit margin. Just pull this, equals that, divided by, where's that cell? Where's total revenue here? Right there. And now for net or EBITDA, we just take gross profit less all these other opex items. Now this can all be drug over. And we have a nice clean 5-year financial forecast. This is a really good operating model as it sits right here. We will add an annual detail, and we're going to add financial statements, some other just items to wrap around it, potential for an exit value. Let's lock the or group these as well. Now, These were originally set up for other cost of goods sold per active customer. We're going to put other costs per customer. And I believe I'm going to keep that. So those aren't just fixed costs. Those are going to be directly tied to the cost per customer. And let's just put just some random numbers in here so we can just see. And I want to keep that logic. So this is going to be that number and then times total consolidated. Oh, we got to unhide to see. So this will multiply by total consolidated customers just to catch anything else that's not else accounted for. So consolidated ending customers is that. So what was it, 543, and there's, you see how many customer accounts here? 30. So 30 should be 150, 140, 90. Or wait, 150, 120, 3 times 4 is 12, 120, and 90. Okay. Okay, so that's working. Yeah, we'll keep that logic in there. I think that's good. There's plenty of fixed cost slots up above. And that actually doesn't make sense to call it a fixed cost. It's just other costs per active customer, total other cost per active customer. And again, more variability is better than less. You don't need dates now because it's just based on customer count. Well, let's keep the dates in. Oh, shoot. Because maybe you start the variable cost starting at some future point, even though customers have already been signing on. So that could be useful. And if not, you just need to make sure the date matches when your customers are starting. Now, this is also not for tier 1, 2, and 3. We're going to just call this item 1 because it's based on all customers. So item 1, 2, 3. Perfect. All right. So if I minimize, you can see everything we did today so far was variable costs, fixed costs, opex, EBITDA. Now, what we'll do next, so this is all the hard stuff pretty much done. We got to put in like a debt schedule if you want to finance with some debt, like any startup costs. We got to put in a startup cost tab, a cap table for investors if you're going to do raise some money, or if it's just an operator endeavor, that's fine too. We'll have to add in terminal value logic and then obviously the financial statements monthly and annual. So usually that takes me a day and a half to do. I'm not going to do it this morning. So thanks for stopping by if you did. And remember, like the video, subscribe to the channel, and let me know suggestions on any other models you want. We will finish this next week for sure. It will be done next week, and you can check out more at smarthelping.com. Remember, you can buy all the templates for $9.99 or buy by category. We got lots of categories, software as a service models and recurring revenue structures, real estate underwriting templates for all different commercial and residential Uh, Items, lots of interesting stuff in here. Industry specific financial models for all different businesses or business sectors. Specific joint venture waterfalls. This is really popular in the real estate sector. Accounting and finance tools for all sorts of stuff. The top one here is really awesome. You can actually build your own financial statements based on a transaction log. It's got logic for accrual and a cash basis, and accountants that have to make their own financial statements would very much enjoy using that. Also, tracking receivables, inventory forecasting, all sorts of fun stuff. All right, well, I am out of here for today, and I will see you guys next.